We have a huge problem. The US Treasury markets could collapse soon. Today, I'm going to be explaining the market signals that show a bond market crash could be approaching, the risk specifically to the US Treasury markets, and how this affects your bank account and investments. Believe me, if a bond market crash does happen, you do not want to be the last one holding US dollars. Stay tuned for more. Former Treasury Secretary Henry has sounded the alarm that the bond market for the U.S. could collapse. What this really means is that the demand to buy U.S. government debt, like Treasury bonds or Treasury bills, is declining. As we talked about, the U.S. government spends trillions each year, whether it's on healthcare, roads, or the military. But one thing has been clear for years is that the US government spends a lot more money than what it brings in tax revenue. In 2025, it spent $7 trillion but only brought in $5.2 trillion, a $1.8 trillion deficit. Where does that $1.8 trillion come from? The US issues more debt, specifically US Treasuries. So to understand the risk of the Treasury bond market collapsing, you have to understand how the market affects inflation and how it affects the economy. So for inflation, new US debt is sold through public auctions by the US Treasury. They sell US Treasuries like T-bills or T-bonds to mutual funds or ETFs run by investment companies like BlackRock, private pension funds, insurance companies, and foreign governments as well. That U.S. Treasury debt, once bought, can be resold in the secondary market or open market where others can rebuy it. There, some of that is sold to other investors, but some is also sold to the Federal Reserve. So you may ask yourself, if it's all the same U.S. government, why can't the Federal Reserve directly buy U.S. debt from the U.S. Treasury? Well, because there's a law called the Federal Reserve Act that prohibits this. So the Federal Reserve can only buy U.S. debt on the secondary market from other investors. Key point to remember is that when the Federal Reserve buys U.S. debt or any debt on the secondary market, they create money out of thin air to buy it. You heard me right. That money is created out of thin air. Elon Musk once described it as 14 magic money computers who created money out of thin air and spent it. Ben Bernanke, a previous Fed chair, once described it as a printing press, saying the US government had a technology that allowed it to produce US dollars as it wishes at essentially no cost. So the Fed is a money printer, and you can guess what happens. When they print a lot of money, that causes inflation because you increase the money supply. The more you produce of an item, unless demand goes up, the value of that item goes down. How much does the Fed purchase? Well, the Fed currently owns around $4.5 trillion of US issued debt. And yes, that's a big number because the total US debt is around $39 trillion. So basically, the Fed has printed out money to buy 11% of its own issued debt. Just think about that for a second. So what's the problem? The problem is that less US debt buyers are starting to show up, which obviously creates an issue if the US government wants to continue to spend more and more. Less and less buyers show up because they are continually examining the credit risk of the US government. It's similar if someone wants to get a loan for a house or a car. The bank evaluates the financial condition of the person seeking that loan, how much salary or income they have, how much other debt they have, and from there they make a determination. Similarly, U.S. debt buyers are looking at the financial condition of the U.S. government and making their own determinations. One important metric that U.S. debt buyers look at is the country's GDP or gross domestic product. It represents the monetary value of all goods and services produced in a period inside the U.S.'s borders. Now, when it comes to the credit risk of the U.S., we look at the different buyers. And one of those buyers are foreign buyers, anybody that's non-domestic. And this is represented by the foreign help percentage of GDP. So it looks at the value of U.S. debt owned by foreign buyers and compares that to the value of the U.S. GDP. And so, as I said before, these foreign buyers are like foreign investment companies, foreign central banks or governments, and other non-US buyers. Now, the absolute debt owned by foreign buyers continues to go up, but it's actually the wrong way to look at this because you have to measure it by the percent of GDP. And a good analogy to understand this is thinking about an individual applying for a loan from a bank. Let's say a person has $1,000 in debt and maybe a $50,000 salary. That person is applying for a loan, but in that middle of that process, let's say that person lands a new job and now their salary jumps up to $100,000 and they still only have $1,000 in debt. The bank now sees the credit risk of that person very, very different. Before, they had an income of $50,000 to pay off that $1,000 in debt, but now they have $100,000 to pay off that $1,000 in debt. So the bankers will likely think the more and more income that person has, the less credit risk there is to actually giving that person a loan. The US GDP is similar to that salary or that income. And what really matters is the ratio of debt compared to the actual GDP. So typically in the past, the measure of debt to GDP from certain investors has stayed steady or increasing. Now we get to the red flag of all of this, is that a certain investor, those foreign debt investors, are pulling back on a percentage basis of what they own of GDP. The appetite of foreign investors to buy US debt at the same rate is not keeping up. And that's for various reasons. You can see that in 2015, it was 33%. And that it went down, but increased in April 2020 to 35%. Now, it's important to note that this was a COVID-related recession, and there was a huge US government spending to offset that. You can see after that has declined by July 2025 to around 30%. So that's been a clear trend, whether looking at 2020 or looking at 2015, of a declining percent. So what's the real risk of foreign debt buyers not buying as much US debt? Well, the US, when it continues to spend at the same level, it has to find new investors. That there's really two other groups. In the green, you had the debt held by private US investors, which is now at 55%. And above in the blue, you have the federal debt held by the Federal Reserve, which is at 14.7%. And don't forget that debt is issued with brand new created money, which does increase the money supply, which does eventually increase inflation. In the red, if the debt held by foreign investors continues to go down, who is going to feel that? So while we hope that the US private investors do, if they don't, then the only other group that can do that is the Federal Reserve banks, in which they would just print new money to buy US debt on the secondary market, which increases inflation. And it's just not an inflation risk. It's sort of a macro risk as well, because even if the private US debt buyers buy more, then that exposes the US government bond market strictly more to the US instead of being more diversified among international buyers. And this is exactly why the previous US Treasury Secretary, Paulson, is sounding the alarm on this, that the US needs to have a backup plan if the Treasury market collapses. Because if they don't, and the Federal Reserve has to buy more US debt for US government spending, you can see inflation go out of control. Next, what should you do? Government spending, such as military, is not slowing down at all. Neither is mandatory spending, such as Social Security and healthcare, which actually face an upcoming crisis in the future. So protect yourself and focus on the fundamentals. Put your money into assets that increase with inflation. If you want to be in stocks but are not sure which one to buy, you can go with a simple S&P 500 mutual fund or ETF. If you prefer some of the best hedges against inflation, you can obviously go into Bitcoin or you can look into gold. The important thing to note is that all signs point to inflation, and you need to act now to protect yourself before a collapse happens. And that's what's the angle on why the US Treasury bond markets could crash. The market signals that show that this could be approaching, and the steps that you can take to protect yourself and your portfolio. But these are just my thoughts. Do you think the Treasury markets can crash? And what are you doing to protect your portfolio? If you enjoyed this video, believe it has some valuable insights, hit the subscribe button, turn on those notifications, and I'll see you next time.